The United States economy has long been seen as a global powerhouse, resilient, innovative, and often capable of weathering storms better than most. But now, many economists and experts are sounding alarms. A recession might be looming on the horizon. But why? What exactly is pushing the U.S. economy toward a downturn? Today we'll break down the real causes behind the possibility of an upcoming recession in the USA using the latest data, market trends, and economic signals you need to know. First, let's define what a recession actually is. A recession happens when the economy contracts. That means 2 or more consecutive quarters of negative GDP growth. It's a period when businesses struggle, unemployment rises, and consumer spending slows down. The National Bureau of Economic Research, NBER, officially declares recessions, but the signs often show up months in advance. So, what's happening right now? Inflation has been running hot, but the fight isn't over. In 2021 and 2022, inflation in the US hit levels not seen in decades, peaking around 9% at its worst. Prices of everything from gas to groceries surged, forcing the Federal Reserve, the Fed, to take action. They raised interest rates aggressively to try to slow down inflation. Higher interest rates make borrowing more expensive for consumers and businesses, which cools spending and investment. While inflation has started to come down recently, it remains above the Fed's 2% target, and many worry it could persist longer than expected. Why does inflation matter for a recession? Because as the Fed keeps raising rates to fight inflation, it risks pushing the economy into a slowdown. Rising interest rates are squeezing borrowers. The Fed's rate hikes have increased the cost of everything from mortgages to business loans. Homebuyers face higher mortgage rates, leading to a slowdown in the housing market, one of the biggest drivers of economic activity. Businesses, especially small and medium-sized companies, find it more expensive to borrow for expansion or day-to-day operations. This means fewer investments, layoffs, and slower growth. Higher rates also mean consumers pay more on credit cards and auto loans, reducing disposable income and curbing spending. The labor market is cooling but not collapsing. After the pandemic, the U.S. saw a surprisingly strong job market with record low unemployment. However, recent months have shown signs of cooling, hiring has slowed, and some sectors are seeing layoffs. While unemployment remains relatively low, a slowing labor market is a warning sign. When companies expect weaker demand, they cut back on hiring or start layoffs, which in turn reduces consumer spending, a huge part of the U.S. economy. Supply chain disruptions still loom. The global supply chain, battered by the pandemic and geopolitical tensions, has not fully recovered. Bottlenecks and shortages in critical materials, semiconductors, and shipping continue to disrupt manufacturing and raise costs. This keeps inflation sticky and reduces the availability of goods, slowing down economic growth. Consumer debt is near record levels. Americans are borrowing more than ever. Credit card debt, auto loans, and mortgages have all surged in recent years. With rising interest rates, servicing this debt is becoming more expensive, putting pressure on household budgets. When consumers are squeezed, they cut back on spending, which is about 70% of the U.S. economy. Reduced consumer spending can quickly tip the economy into recession. Geopolitical risks and global uncertainty. The war in Ukraine, tensions with China, and ongoing political instability around the world all add to economic uncertainty. Rising energy prices due to geopolitical conflicts impact inflation. Trade disruptions also hurt U.S. companies that rely on global markets. Investors tend to get nervous during such periods, causing stock market volatility that further undermines economic confidence. Stock market volatility and wealth effects. The U.S. stock market has faced significant ups and downs in recent years. When stock prices fall sharply, many Americans feel poorer, especially those near retirement who rely on investments. This wealth effect means people spend less when their investments shrink, leading to slower growth. Yield curve inversion, a classic recession warning. One of the most closely watched recession signals is the yield curve, the difference between short-term and long-term Treasury bond yields. In 2023, parts of the yield curve inverted, meaning short-term rates rose above long-term rates. Historically, this inversion has predicted recessions with surprising accuracy, often 12 to 18 months before the downturn. Putting it all together, the combination of persistent inflation, aggressive rate hikes, slowing labor markets, consumer debt pressures, and geopolitical uncertainty creates a precarious situation. Each factor alone is manageable, but together, they increase the risk that the U.S. economy could tip into recession. But what about the silver linings? The U.S. consumer is still spending, helped by strong savings built up during the pandemic. The labor market, while cooling, hasn't collapsed. Inflation is gradually coming down, suggesting the Fed's strategy is working, albeit slowly. The bottom line: recessions are a normal part of the economic cycle, and while painful, they also clear out imbalances and reset markets for future growth. The key question is timing and severity. Will the Fed manage a soft landing, or will the economy suffer a sharper downturn? What should you do? Keep an eye on interest rates and inflation reports. Watch employment data closely. Be cautious with debt, especially variable rate loans. Diversify investments and prepare for volatility. If you want to stay ahead of the curve and understand how these economic shifts impact your money, career, and future, subscribe to this channel and hit the bell icon. We break down complex economic events into simple, actionable insights. Thanks for watching, and remember, knowledge is your best investment during uncertain times.